Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, August the 11th, and wanted to take just a brief moment to discuss what we saw in equity markets last week, discuss what economic data that we received this week and the importance of that data that we received this week, and the impact that it has on equity markets moving forward. And so last week was a relatively flat week as we started off August coming off the best month that we've had since 2020 in the equity markets. And that really all started on the rally on July 13th, which was the bottom of the equity markets. And we've really rallied higher since then. But last week, the S&P 500 did finish the week higher, 30 basis points or 0.3%. The mid-cap index, as measured by the S&P 400, was off 30 basis points or down 0.3%, and the small-cap index, as measured by the S&P 600, was off 10 basis points or 0.10% as well. So relatively flat week overall in the equity markets, but all eyes this week were on CPI, which came out Wednesday, and CPI is Consumer Price Index, and that is the measure that the consumer is facing when it comes to inflation. So how much are you paying year over year for goods and month over month for goods and services in the economy? And the encouraging sign was the expectation year over year was for 8.7% inflation, which is a very high number for the month of July. And the inflation came in actually a little less than expectations at 8.5%. Now, the important number was the month over month inflationary measure. The expectation was for inflation to be up 0.2% month over month, but it was actually flat month over month, which is incredibly encouraging if you are an investor, because what that is showing and hopefully in reports to continue, that inflation has indeed peaked and is coming down, which means then that the Federal Reserve can be a little less aggressive when it comes to interest rates rising. So one of the interesting things, so the last two Fed meetings, the Federal Reserve Bank has raised interest rates 75 basis points. They do not meet this month, they meet next month. And so going into this month's CPI report, the expectation that the market had was overwhelmingly support that the Fed was going to raise another 75 basis points in the September meeting. Well, with the data that we got yesterday and today, and we'll discuss that data in just a second, we now saw the Reserve Bank's policy, the market saying that we think that the Fed's going to go from 75 now down to 50 basis points on their next rate hike, which is a catalyst for stocks to move higher the lower the interest rates go and allow growth rates and growth stocks to come back. And that's what you've seen in the market. Is what the market is pricing in is that the Federal Reserve is going to be less aggressive than they're going to not have to be as aggressive as they have been to fight inflation, that inflationary pressures are starting to come down, which will cap how much they're going to raise the interest rates, which will then allow the growth stocks to continue to recover and rebound from the destruction they've seen this year in the equity markets. So we fast forward to this morning, we get what's called the PPI number, or the Producer Price Index, and that is what companies are paying for their goods or their raw materials or whatnot that you pay, that they then pass on and impacts the consumer. And the big new headline here is while the number was still high year over year, it was less than expectations. But most importantly, month over month, the expectation was for it to be up another 0.2%. It was actually negative 5.05%. So you saw a decrease month over month in prices that the producers were paying for goods that they put in to make final products. Again, another encouraging sign that inflation may have indeed peaked in June. And we've seen that in energy prices, but if you peel the onion back a little bit further, you can see it in a lot of commodity prices. You know, copper, for example, was in the $6 range. It's now back down in $3. And you've seen it in lumber, you've seen it in a hot roll of steel, you've seen it in a lot of commodities that have come back down, which is reducing pressure. Again, leading to the thesis that the Federal Reserve in September is not going to have to be as aggressive. So all eyes are really on what the Federal Reserve Bank is going to do and if they can indeed engineer a soft landing. As you know, we've had 2 negative quarters so far this year of GDP, and we're in a little bit of what is known as an inventory recession. And you actually saw markets rally off of that on Thursday, July the 28th, when that report came out. So we believe, and the investors are betting on the soft landing that the Federal Reserve can navigate, that the economy is going to rebound. And all that was priced in June was that we were heading into a recession. And when we got those data points that we are in a slight inventory recession, you actually saw markets rally off of that because they believe that we're going to be out of it beforehand. And again, all signs are pointing to the Fed being less aggressive. So if we are indeed in that recession, the Fed is not going to be raising rates as aggressively. So that is what has allowed the market to rally, and we expect the market rally to continue up until the next Fed meeting in September, where we might see some pause to see what the Federal Reserve Bank does in their next meeting. So as always, if you have questions about what's going on with your individual portfolio or ways in which we can help you navigate this market, feel free to give us a call. We're easy to talk to. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for listening. Goodbye.